Well, welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Joe Viery. And Joe is the founder of USTAGI. I don't know how to pronounce that. USTAGI, with the goal of providing quality cost segregation studies. So as a cost segregation specialist, Greg has seen all kinds of properties and has helped multiple property owners defer or eliminate millions of dollars in income taxes by leveraging something that is part of the IRS code, which is cost segregation studies. And since becoming a CSP in 2007, Joe has performed thousands of cost segregation studies for clients in various industries, from like $500 million commercial properties to $50,000 single family residences. So he regularly presents at workshops nationally and is a frequent guest on industry podcasts like this one, Break Away from the Rat Race. Joe, welcome to the show.
Well, thank you, Eric. Thanks for inviting me.
So tell us a little bit about your business. So it sounds like you started in 2007, and so tell us a little bit about that. And why did you choose to do this? What excites you about cost segregation, and why we should be excited about it?
Great. That's a great way to start. And my story is a little unique, and I think it adds to the podcast. I have always been entrepreneurial. I started from college and I owned, believe it or not, a travel company for 20 some odd years.
You look like a little bit of a traveler person.
Yeah. I mean, I've been all over the world many times, and you've taken
Nice.
corporations and sports teams and insurance companies, blah, 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 on all these trips all around the world.
Yeah.
And then in 2000, I sold my business, and I was a business management major. So I went into business services, and I worked for the California Association of Realtors.
Mm-hmm.
And I was a licensed analyst as securities. And so I was helping their members with retirement issues and tax issues. And then a guy kept coming to me, a friend of mine, I think he was in insurance, and he wanted to tell me about something new that he found out about and he thought I could use. And I kept blowing him off because I thought he was wanted to sell me soap or Amway or something. And so finally I got tired of him always bothering me. And I said, okay, Mike, let's go have lunch. And he told me about this study that eliminated income taxes for building owners. Mm-hmm. Well, obviously I'm in the real estate industry, and I had clients who were looking at $50,000 plus income taxes, and they didn't have the money. And I shared it with them, and they said, yeah, let's do it. So that was in 2007. Mm-hmm. And what happened in 2007-8 is the car went to the edge of the cliff and then went over. Mm-hmm. And when the car went over the cliff, the California Association of Realtors lost a lot of members, like maybe half. And everybody in California was it was not, the real estate industry was dead. It wasn't dying, it was dead. Yeah. And the guy that I did the cost seg study was with, the company, the engineering company, said, Joe, you're really good at this. Why don't you come and work for us? And I said yes, and I never stopped, because what happened in my story, which was maybe planning or maybe I was just lucky, is that I fell into a group of clients who had a lot of cash. And when everybody else was suffering and selling and couldn't make their mortgage payments, they had cash and they were buying. Mm-hmm. So they were paying a lot of income taxes. And so I started uphill, and I've never stopped. Mm-hmm. I've been busier and busier and busier every year. And somebody asked me recently how many studies I've done. It's so many that I couldn't even begin to tell you, but probably closer to 20,000.
Oh my God, that's a lot.
2000. Yeah,
that's more than I thought.
I've done so many, because some of my clients, I've done some, like, single family homes, and they've owned a portfolio of 800 buildings.
Yeah.
That's one client.
Yeah.
So, and it's a great topic, because obviously what I share with my clients, you hit the nail on the head, is I reduce or eliminate income taxes. Mm-hmm. And there's nothing more gratifying to me than if somebody comes up to me and says, my CPA, Joe, told me I need to write a check out for X, 20,000, 5,000, 100,000. And I tell them, you know what? You don't have to write that check. Keep it in your bank, buy more real estate, improve your real estate assets, because you don't need or if you want, you can, buy a car. You can you can buy your college, education for your grandkids. But bottom line is, you do not need to write that check to the IRS. And I've impacted a lot of investors, and it's a great feeling.
Oh yeah, and just from my personal experience, I use like cost segregation studies as well for apartment buildings that I bought, and it was the perfect timing. I mean, you just buy, you're supposed to have like pay taxes. You're looking, we're looking right now at calculating how much taxes I'm going to pay. I'm liable for, let's say, this year, and then I say, okay, well, what can we do to eliminate taxes? And one of the greatest way to do this is a cost segregation study on a real estate, and then taking advantage of the bonus depreciation, and then really accelerate that depreciation. So, and that worked great. I mean, you can really eliminate, pretty much all your tax liabilities with that, depending on which states you're located.
Yeah.
But so yeah, from my perspective, I think it was fantastic when I heard about that and how it worked. So, but not everybody knows that. So let's talk about how it worked, and what's the concept behind the cost segregation, and then why it helps you reduce taxes.
It's a complex topic in many respects, because it involves accounting and it involves engineering. And I get it. Those are two probably unpleasant topics for a lot of folks. But I can kind of make it, I think, able for people to digest. Basically, what the IRS is telling those who own real estate is that you're using up your real estate as you own it. And so if I use one example, if somebody was in a apartment or office building, and I look down at the floor and I say, you have carpet, and I tell them that the method of depreciation that most accountants use is called straight line. And that is simply, you divide the building basis. So again, when you buy a property, part of that's land. Land is not a depreciable asset. So you have to take that out, to deduct that from the purchase amount. And again, it's the purchase amount. It's not the fair market value of the property. It's what you paid for it. That's all the IRS cares about. They could care less what the property's worth today. So if you take out the land and you have the building basis for a residential property, you divide by 27 and a half years. Who came up with 27 and a half? I've never researched it. I don't know. It was done by Congress.
Engineer, I think.
Pardon?
Probably some engineers, I think.
Yeah, probably some engineer. Well, one of our favorites. So you probably had nothing better to do at night and came up with 27 and a half.
Yep.
For commercial properties, it's 39 years. So what does that mean? That means for let's round up to 40 years. The IRS says, okay, that floor, that carpet is going to last 40 years. You're going to divide, the building basis by 40. So you're going to get a really small amount of a deduction. And a deduction is helpful in reducing your taxable income. So you have your gross taxable income. Let's say it's $100,000, and then you have expenses. If you have $50,000 worth of expenses, now your taxable income went from $100,000 to $50,000. Well, how do you get more expenses? One of the ways you can get more expenses is by using the expense called depreciation. So you can divide by 40 years or 27 and a half years and get a little bit of that expense every year. However, what the IRS came to the conclusion, which makes sense, is if you look at the carpet's not going to last 40 years. Exactly. You'll be lucky in a commercial building if the carpet lasts 3, 4, 5, 6, 7 years. So it's not going to last 40 years. So everybody can get their heads around that concept. And the IRS, because of this court case in 1997, where the judge found in favor of the company that sued the IRS, and he found disfavor with the IRS, the way that they were kind of, not letting people, they didn't share the information about the correct way to depreciate a building. So he made them, the IRS, publish a 200-page audit technique guideline for cost segregation, and the industry kind of took off. So I've been doing this since 2007. The audit technique guidelines came out in 2004. And basically what it says is there's a whole selection of building components that the IRS agrees that don't have lives of 40 years or 27 and a half. They have shorter lives. For the interior of the building, it would be 5 and 7 year. For the land improvements, it would be 15 years. So bottom line is they agree. And it's not even an issue. The IRS recognizes that the correct way to depreciate a building is by accelerating the depreciation by performing an engineered-based study called cost segregation. And that's basically it. So what I'm giving everybody is a huge bump in their depreciation expense, which reduces your taxable income. And in most cases, I can eliminate their taxable income.
Yeah, I mean, this is great, because I think one way that I explain it is that when you buy a building, you can say I'm buying the whole building and I depreciate over 27 and a half years, but really a building has all kinds of different components, and each of these components has different depreciation schedule. And then I can say, well, my HVAC is not going to last 27 and a half years, like you mentioned with the carpet. So I'm able, with the cost segregation, you basically put all these things, they depreciate over 5 years. These things depreciate over 10 years. This is like 15 years. And then I can then accelerate the depreciation for the building when I break it down into its component. And for people who don't know, a depreciation becomes a real expense in your income tax, which is a little bit it's kind of like weird, because you're not really paying anything, but they're basically saying that this HVAC, you're going to pay for it it's going to be an expense over a period of time, because the value is going to decrease, but it turns into a real expense from that perspective.
Perfect.
So, yeah.
Perfect example. Yep. Great. Now, one thing I would like to stress is that it's a moving target, my industry, meaning that the IRS everybody takes the IRS to a court case, and so it's a moving target, meaning that if a judge decides that something else should be 5-year or 15-year or stay in 27 and a half year, and there's a ruling, then the rules of the game change. Part of the job of a competent quality engineering based company is to keep on top of all of the rules and regulations as they change. And like, for example, one that changed, we would take bathroom vanities as a 5-year property. And a couple of years ago, the IRS came back with a court case and said, nope, bathroom vanities have to stay with the building. So bathroom vanities are now 27 and a half year property, which was like, excuse me. So the kitchens are 5-year property, but the bathroom vanity, some judge made the decision that stays with the building. That's 27 and a half year property.
I guess they're not married. They don't have a wife. You know that the bathroom vanity is not going to last for 27 and a half years.
Yeah, a lot of these decisions, people will ask me all the time, like they'll see a bollard. A bollard is a metal tube with cement in it that protects the corners of buildings and a lot of building construction. And they're called bollards. And people say, wait a minute, that bollard's 15 years, cement and metal, that's going to last 100 years. Well, it doesn't make any difference. When the IRS comes out with a decision on the life of an asset, that's just the decision. And some of them don't make sense. And I'll be the first to agree. A lot of things to do with the IRS and taxes don't make sense.
You would think it would be more like statistically based and look at how people are doing things, but interesting. So, all right. So now we've done the cost segregation, and you basically are giving a report, right? So we hire you to do a cost segregation, let's say for an apartment building, and then you're coming up with a report. And that report, what does that report say?
Basically, the report, the important parts of the report are the Excel spreadsheet part, where we break down all of the lives of every component of the building. So we mentioned the short-lived assets, 5, 7, and 15 years, but we break down everything. We break down the windows. The windows are 27 and a half. We break down the doors. The doors are 27 and a half. The roof is 27 and a half. The HVAC is 27 and a half. We break it all down, and we give on a detailed engineering report, we give a line item at every building component, and we assign a value. We do not create the numbers. We reallocate from the numbers the client or the accountant give us. So we're not land appraiser. So somebody's got to take out the land part of the building. It's not going to be U.S. Tax Advisors Group. It's going to be the client or the accountant. And then we will reallocate from that number, and we're going to pull out all of the components. So again, another misconception is people say, well, wait a minute, I went and bought a 2x4 at Home Depot and it was, $18 for it. It makes no difference. That 2x4 is in relationship, when you do cost segregation, to the basis of the building. All of the components come out from the basis. So I'll use an example. Let's say you buy a single family home for $120,000. You take out $20,000 for the land, and now I have $100,000 to work with. That 2x4 is in relationship to the $100,000. Not what it cost at the store. Plus, there's a little bit more calculations because we can also do look back studies. A lot of people don't know this. I can go back about 15 years.
Oh, 15 years.
So when you acquired the building. Now, I can't go by what the building's worth today, remember?
That's right.
I can only go by what you paid for it. So maybe 15 years ago, you didn't pay very much for it. So it might not be worth doing. But what we do is we give everybody an estimate at no charge. And we tell them, if it's not worth doing, I'll tell them. It's not worth doing. Don't do it.
So this is great. So then you have that, and then for us, like in order to assess the land value, we basically looked at kind of like the percentage that the city allocated for the land versus the improvement on the property tax bill, and we kind of used that so that it was a very defensible position.
The IRS loves the county tax assessor. They love it. Now, I have seen the county tax assessor be way wrong because they're not valuing the land allocation for the reasons we're valuing land and cost segregation. So keep that in mind. So if you have a crazy number out there, like, you're in, I'll make no offense to anybody, Oklahoma, and the land allocation is 40%, I would be scratching my head thinking, what the heck? Because 40% in Oklahoma, 40% in the beach in Miami, that may be true, but not usually in Oklahoma or Texas.
So you have to have your head on as well, and also so it depends what how much you paid for the building also, and kind of like but that's a good starting point at least. But the idea is that you have to have a defensible position in case the IRS comes back to you and say, hey, you know what are you smoking?
And the county tax is defensible. They love that county tax. They love it. So if you want to know the most defensible, it would be use that number, and if you can live with that number, you're done.
So you do that also for, is there a different process for the residential kind of cost segregation? Can you tell me about that?
Okay, so we do two-ish, because we also do a kind of a hybrid, but we do what's called, and this is what I grew up on when I first started. It's called the detailed engineering study. And the detailed engineering study means, like I said, we go out and we count all of the building components. We measure everything: cabinets, countertops, flooring, ceilings, roof, all of that we measure. So how do we measure it? Well, we have to send somebody out to measure it. And it's one of the engineers goes out there and measures everything. And then we also have to spend engineering time in producing the values, the allocations, and completing the report. Well, if you have a building with a basis of 500,000 or less, single family homes, it won't pencil out. The value proposition won't work if I have to send somebody back to Oklahoma, get on an airplane, or send somebody to drive up to the building. Those reports cost thousands of dollars. So we developed about 6 years ago with what we call a modeling study. And what we do is it's an analytical approach. So we're getting to the same end, but we're using a different method. What we're using is we're using our database of similar type buildings, similar type construction, same geographical region. And what we're doing is we're preparing a report to tell the IRS, okay, for this 3-bedroom, 2-bath home in this city, you can expect to find so much in 5-year property and so much in 15-year property. So you're going to get the acceleration, but you're not going to get the detail because we're not out there measuring countertops.
Yeah.
Not out there measuring anything, but at least you're going to get the accelerated depreciation to reduce or eliminate your income taxes.
So you're going to say, for example, that, well, 20% of the building or 10% of the building is really 5-year depreciation. This is 10 years, this is 15 years. And then they can your CPA then would allocate that.
Now, the modeling technique is not meant to replace the detailed engineering.
Yeah.
It's meant to, give somebody the advantage of doing the accelerated depreciation without spending that kind of money. Otherwise, for a building basis of $300,000, no way is it going to be worthwhile to send somebody out there to measure all of this stuff. But it is recognized by the IRS. It's a legitimate method. It's just, and we're the first to tell everybody, it's not the top.
Yeah.
The top is the detailed engineering, and then they've got different types of studies. This one is the one, it's like 3/4 of the way down. It's not the lowest one, but it's not the highest methodology. So you're not going to get the highest amount of acceleration, but you're going to get a really for the value. And these studies cost hundreds of dollars. For the value, it's going to do really well.
Yeah. So how much does it cost to do like the reason why I'm asking is that there are a lot of people on the multifamily and commercial building. I think a lot of people are aware of the cost segregation for the most part. On the single family rentals, many people are not aware that they can do it on single family rentals. They don't know where to go and how to do it. And so that's going to be very good news for them to be able to do that. How much does it cost to do a single family rental on average in your industry for
Okay, we also break down the studies into another two types, and that is basically current tax year and the look back studies.
Okay.
And so current tax year studies do not need a change of accounting method form. If we do a look back study, what in essence we're telling the IRS is, okay, I bought this building. I'll make up a number in 2020.
Yeah,
I bought this building, and since 2000 I've already reported 2 tax returns, 20 and 21, and now I'm shifting gears and I'm going to tell the IRS I've changed my mind. I now want to accelerate it.
Yeah.
So you have to file a form 3115, and there's a calculation that must be done. How much depreciation did you take in those 2 years versus how much new depreciation are you going to get in the acceleration?
Yeah.
And then somebody's got to do the math.
Yeah.
We cannot sign tax returns, so we do not fill out the form 3115, but we do the heavy lifting. We do the calculations, so we charge a little bit more for look-back studies.
Okay. Yeah.
So a look-back study will cost $675. A current year tax study is $625. But because people are coming to us from a referral source, which is Eric, then you can take $100 off those prices.
Ooh. And I don't get that $100, so enjoy it. Go after dinner. So this is great. So now you get the cost segregation study. The nice thing about this is that with the bonus depreciation, I think it was I think it was done like in 2000. When was that law passed?
Well, the law passed it finally came into being in 2018. It was the Trump tax law.
Yeah.
What it was known as Tax Jobs and Something Act. Yeah. And so, but bottom line is, but here's how it's not that important when it became law because it did go back. So if you bought a building after September 27th of 2017, you can qualify for 100% bonus depreciation. Now, again, I started in 2007. We didn't have bonus depreciation. So to me, it's nice, but it's not the end all to everything. So bottom line, what does it mean? Here's how the rule works. That part of the code works. It says any component of the building with a life of 20 years or less, you can write that off, deduct it entirely in the year you do the study. 100% of that.
100%. Yeah.
100%.
Yeah.
So if I find 25% in that $100,000 single family home, which is $25,000, you can deduct that $25,000 as an expense off your taxable income.
Yeah.
Now, what happened in the past? Well, what happens in the past, it's a mathematical error, not error, it's a mathematical situation where if you have 5-year property 15-year property and 27.5-year property, how the benefits would be in effect is you would get most of it in the year that you do the study, and then there would be trails. You would still get the entire amount as you do with bonus depreciation, but not all in the first year. You would get like 80% the first year. You'd get a little bit more in the second year, the third year, the fourth year, the fifth year, until all of the accelerated depreciation is used up. So what's going to happen in 23 is that 100% is going to go down to 80%. And then it's going to go down to 60, 40, 20 until 100% is gone. Is that going to be a main reason to do cost seg? Like I said, my feeling is it's nice, but it's really not the end all of everyone. And plus, who knows what's going to happen with Congress?
For me, it was a massive change. I mean, it was worth over, like, I think it was like $300,000 in bonus depreciation that I was getting by buying that building. It was massive. Now, keep in mind though, that 300,000 you'd still would have gotten, but you wouldn't have all got it in that 1 year. It would have. Well, I would have got it over a longer period.
And who wants to wait? Because what we give everybody is the time value of money. So in other words, I give you the same. This is key. I give you the same amount of depreciation as you're going to get after 27.5 years. The only difference is I'm giving you 25% now, and you're going to save $15,000 in income taxes today rather than saving a little bit of that money every year. Well, you want to go out and you want to use the current year. You want to use that money today. You want to wait 27.5 years to get the value of that money because, you know, the value lessens over time. So you want to get the biggest bump possible. And that's why accelerated depreciation is the way to go.
Yeah, to me, that made a ton of sense. But of course, you have to make sure that, you know, if you don't have the income to offset it with, then it's, you know, you don't need to do the bonus depreciation. These are all choices that you have when you own the building. You can say, well, I need more depreciation. I want to do an accelerated depreciation. I want to break it down into this different component. That's going to accelerate it somewhat because now the 5-year component are going to depreciate over a 5-year period. And then instead of 27.5. But then on top of that, if you want to elect the bonus depreciation, then you can deduct 100% of that item this year if you need it, if you have the ability to do that.
And it is beneficial. It's powerful. I'm not meaning to
no, but it depends. I agree with you too. Like it really depends on your situation. So you should really talk to your CPA and say, okay, well, I'm going to do that. And sometimes you can do it also. You don't have to do it. Like you don't have to do it right now for 2022. You don't have to decide to do that. You can go and wait until January, February of next year, and then look at your situation in terms of income tax with your CPA and say, oh yeah, you know, these 2 buildings out of 10 that you did, you should do the cost segregation. You should do the bonus depreciation on these, and then we'll move forward with that. So that's a great way of doing that. So you don't have, because you have the building doesn't mean you have to do that. Nope. The option is really all yours, and this is great to have these choices.
And one thing we're not an accounting firm, so we don't give out any accounting advice or any legal advice when it comes to this. But I've been doing it for so long that I probably have heard every question imaginable out there. But you know, definitely, what we do is we give everybody an estimate, and I don't I don't tell them what to do. Let's say your example, 10 buildings. I will give you an estimate on the 10 buildings, and I'll say it's up to you to pick and choose which ones you want to do. You could do 2 this year, 2 the next year, 2 the next year. You could do all 10, because if you do all 10 and you don't need all the losses carry forward. That's a net operating loss. So you don't lose it. And so some people just say, let's just get all 10 done. And they keep the net operating losses in the bank, and they use them the next year, the next year, the next year.
Yeah. And it depends on the intent as well. Like if you want to sell them in the next 3 to 5 years, then you probably don't want to do a cost segregation.
No. Okay. I'm going to back you up a little bit on that.
Yeah, go ahead.
Because I've been doing this for so long and I've talked to many CFOs, I came up with more of a 2-year process. What I tell my clients is that if you are not going to own the building for at least 2 years, don't do cost seg.
Okay.
Now
Yeah.
you might have a really high IRR. You might be a flipper, and you may have such a high internal rate of return that you can make the numbers work. But there is a component of the tax law called depreciation recapture.
Yeah.
And so if you're not gonna hold the property for 2 years, I'd say why waste the money and the time, and it's probably not worth it. You're not going to lose money, but it's probably not worth the effort.
Yeah.
But if you hold it for at least 2 years, I can show you proof that the numbers will work if you hold it for at least 2 years.
Yeah.
That's one reason why people don't want to do cost seg. If you're a flipper, you're not a good candidate for cost seg.
Yeah, exactly.
Yeah.
Yeah, but if you hold it longer term, I was thinking more 5 years, but yeah, if you start seeing value after 2 years,
The longer the better.
I mean, that makes sense.
Longer the better. And that's what I preach to my people. The other thing you mentioned this is that as far as the 2-year time period, that is a moving target. So in other words, I'm just giving you just a threshold amount. The other factor that comes into to play is that some people, because real estate is such a incredible investment, some people don't pay income taxes.
Mm-hmm.
There's a lot of reasons why you get into real estate. One of them is because of tax mitigation reduction.
Yeah.
And so a lot of people come to me and they say, I want to do cost seg. And I go, well, how much are you paying in income tax? Mm-hmm. Nothing. Well, why are you doing cost seg? I don't want to take your money if you're not paying income tax. So you only want to call Joe when your accountant says,
exactly,
to write a check.
Yeah, exactly. I mean, you have to have the AGI to back it up to be able to take advantage of that. Otherwise, there's no real advantage. Yep. So okay, so you got your cost seg, you do all of that, you do the and then you pass that on to your CPA. Any issues with the CPA?
Okay, in the good old days back when I started, the common question was, this must be a scam. And then the accountants would be the same way. They go, oh, no, I've never heard of it. And I don't like this, because they couldn't do it. So they didn't want to hear anything about it. Today, nowadays, you hit the nail on the head. If you own a multifamily, I do find these people, but if you own a multifamily, your accountant better know about cost segregation. And if you're holding it for more than 2 years, and you have taxable income, he better be recommending cost seg for you to do. But we've gotten over that threshold, meaning that most accountants, if they don't know who to turn to for cost seg, they've at least heard about it and they know that it is legitimate and it works. Yeah.
If your CPA doesn't know about cost seg and you're in real estate, fire your CPA. Find another one.
That came from you, but I agree.
I mean, I had a CPA like that. Like, he didn't know how to do he didn't know about cost seg. And when I brought it up to him, he said, "Oh," and he had to look into it. And he said, "Oh, that's a pain. That's a pain in the neck. That's a pain. It's worth a lot of money. I don't care if it's a pain in the neck. You're gonna do it, or I'm gonna find someone else who will." And he said, "Oh yeah, it took him months to enter it into his archaic software and all that kind of stuff." And it was ridiculous. And
I see a lot of accountants out there, and a lot of accountants are not real estate accountants. And you're probably going to ask me this in the closer to the end, but I'll cut you off and I'll answer it now. One of the strongest suggestions I can give, because I see this day in and day out, is get a good group of advisors. If you own real estate and invest in real estate, get an accountant who knows real estate. Otherwise, I will tell you, you're going to be spending money that you do not need to spend. Yeah.
Business is a team sport, people. Team sport. So build a team. Everybody, Grant Cardone says, even Jesus didn't do it alone. I'm not a religious person, but I thought it was a very good quote.
No, that's true.
Jesus didn't do it alone. So this is very interesting. So if people are interested in, so then you pass it on to your CPA, and then they would, obviously your CPA should be involved in that conversation, because he would tell you, he said, does it make sense? Because there's also passive income versus active income. There's also whether you're a real estate professional, and all these things, these components also affect how this depreciation, this bonus depreciation or accelerated depreciation would actually affect your taxes. So you want to have your CPA as part of the conversation here to make sure that it makes sense for you to do it, and to what degree it makes sense to do that.
Yeah, we provide you the report, meaning the client, and then we provide, if we have his contact, we provide him the accountant with the information. And if he needs help, although we're not filing tax returns, we know our job and we can help him, whether it's with a 3115 or it's with any questions regarding any application of the report we give them, how to read the report, etc. We're there for the client and for the accountant.
Yep. Excellent.
And then, oh, by the way, wait, one thing is that we do defend our reports too.
Oh, okay. Yeah. Oh, that's good.
Yeah. And that's important. So
yeah.
That's what you're buying when you have a professional company like US Tax Advisors Group, is that you know that if you get questioned by the IRS, we will answer the questions pertaining to our report, of course. And we don't charge.
Yeah.
Now, the next question is, everybody wants to know, well, how many times have you been questioned or audited? I hate this answer, but it's the truth, so I have to say it. None of my work has ever been audited.
Yeah.
And I've been questioned once, and it really wasn't a question about my work. It was more a question about the accountant's allocation of the building. And so I was able to answer it for the accountant. I wrote the reply back to the IRS explaining it was a multi-use building, and it was part commercial and part residential. And so it wasn't my job to define the depreciation, but I still was able to answer how the accountant came up with that. So I answered it, and then the IRS never got back to, I mean, they accepted the answer and that was it. So I just don't get the day of cost segregation triggering an audit is long gone.
Yeah, I never had any issues with that, so it was always very clean. And so this is excellent. So if people are thinking about this, any kind of like last minute advice on what they should be doing? I mean, we're approaching the end of the year. I mean, I think for me, like, I would kind of like start working with your CPA if you have a lot of properties, and then kind of look at what your needs are going to be in terms of tax deductions. And then, once you have a more final numbers, then decide kind of how you want to move forward with cost segregation studies.
Well, this is the great time of year. We just got done with the last deadline, which was October 15th. Extremely busy prior, but now everybody can take a deep breath. But don't take too deep a breath, because now is the perfect time to get estimates from your cost seg professional. Take your estimates to your accountant and start developing a game plan of how you're going to mitigate, reduce, how you're going to plan for your taxes for 2022. So don't waste this time, but you don't have to be like, I got to get it done tomorrow. Just know that by the end of the year, you should come up with a good plan to discuss with your accountant. And if you, like I said, we provide the estimates at no charge, no cost. Get an estimate, walk into your accountant during your year-end meeting and just say, hey, look, can I use this? Joe's going to give me this much in losses. What do you think? Is this something I can use or not? Shall we move forward? And if he says, no, don't, because of issues, there's very few. You hit on one, passive issues could be an issue. Not very often, but I understand. So just ask your accountant, and we support your accountant 100%. We don't argue with anything your accountant's going to say. If he says don't do it, I'll agree. Don't do it.
Okay. Any last minute advice?
Well, I think I already gave him my last minute.
So I was wondering if there was more.
No.
Okay, very good. If people want to reach out to you, where can they reach out to you?
Well, the name of the company is US Tax Advisors Group Incorporated, but the easiest way is just write down USTAGI. USTAGI.com.
Yeah, exactly. So that's the name I screwed up at the beginning. I didn't realize it was US. I thought USTAG.
Yeah, well, we kind of play on that too. So.
Yeah, USTAGI and then .com, and then you would find all the information.
But you know what? I do have one thing to say. I'm going to be very quick on this.
Oh yeah, it's all good.
Another tax legislation that came into play in September. I think it's called the Inflation Reduction Act.
Yeah.
Okay. That impacted the energy tax credits.
Okay.
That's going to become very useful and very beneficial. They changed the rules. They've made it now. They've extended it until like, I think 2032. And if anybody's done any value add, if you bought any value add and you've done any work in the last 3 years on a building, you should at least ask your accountant if you could apply for any tax credits.
Okay.
Because these are going to be big.
Okay. Okay. Excellent.
All right.
All right. Excellent. Thank you, Joe. It was a pleasure. So,
thank you, Eric.
You like and subscribe, and then because every week we're talking to people like Joe that are providing incredible advice to us. So thank you very much, Joe, and talk to you next week.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.